The big news of the day is the Federal Reserve. The Fed madness is what we need to cover right now. I'm going to show you why this is important to you, your stocks, your portfolio, everything. The second thing I want to look at is this major inflation that is coming our way and that will persist at least for the foreseeable future. And of course, we need to talk about wild stocks as well. It's going all over the place. Let's begin. It wouldn't be a Money GPS video without the Fed repo update, and it has accelerated to a new high. Take a look. $1.15 trillion in this reverse repo in a single day. 82 counterparties taking place. We will find out in 2 years exactly who they were, but I think it's just interesting to see that this continues to go higher. You could see the chart. I mean, it is unbelievable. And of course, it's not going to stop. Let's be honest. Now, you need to know exactly what's going on with the Federal Reserve and how that affects stocks. Why? Because even if you are diversified, as they say, because you own the S&P 500, this affects you directly. Dow and the S&P 500 booked the worst declines in a month after the Fed meetings show taper plans later this year. Now, of course, this is the initial reaction. This is that knee jerk. This is not something that may persist, right, over the next few days, over the next few weeks. But this shows you that the market is very concerned. You could see right now, I'm showing you the NASDAQ, and as I have been covering, this market has been very weak over this period. In fact, we are at approximately the same levels from late June. So it has not been able to move through this period. It has not done well. Now, while the Dow Jones had been performing worse over the period of time leading up until late June, this, of course, had performed a little bit better. I mean, we're at the levels we were at in, July 12th or so. So that just gives you an idea. S&P 500 as well. It is, if you look at the Dow Jones and the S&P, they're looking at some definite weakness here, being supported by the 50-day moving average on the NASDAQ. Looking at the Dow Jones, again, not even touching the 50-day yet because it had moved up so high previously. And then this is the S&P 500, which still is actually quite healthy in terms of what's been happening. But the short term, just the short term, is that we've seen a little bit of negativity here because of this taper talk. And I want to look at that in depth. Federal Reserve preparing for taper this year, July minutes show. So quickly, I just want to show you this. This chart is what you can see from the period of time from the last meeting up until present. What has happened to the markets? Gold. And just look at that. It's basically down slightly. Okay. You're looking at the dollar. That's the red line. It's up slightly. And you look at the, developed markets. You're looking at the treasuries. You're looking at basically everything through this period. It's been about the same. Not much has changed. Why? Because they're just waiting for those minutes to come out. What did they say behind the scenes? Is there going to be a taper? And now we have that information from behind the scenes. And they made this very clear, which I find interesting. Officials stressed that there is no link between tapering and potential interest rate hikes. Basically saying we can start the process on the tapering. That means how much money they're printing per month. And that's not going to be a factor for interest rates. Don't worry. Interest rates are going to stay at 0%. They wanted to make that very clear. Quote, looking ahead, most participants noted that provided that the economy were to evolve broadly as they anticipated, they judged that it could be appropriate to start reducing the pace of asset purchases this year. They made that very clear. This year, 2021. The minutes stated, adding that the economy has reached its goal on inflation, and was close to being satisfied with the progress of job growth, meaning this is the time to do this. Minutes highlight a Fed split over labor market bond buying taper. So it depends on, the comments you get, but that all depends on the day that they'll begin. Are they going to begin in September, October, or is it going to be December? That's the real toss-up here. Federal Reserve officials felt that the employment benchmark for decreasing support in the economy could be reached this year, but appeared to disagree on other key aspects of where monetary policy should turn next in the transition from the crisis, according to the minutes. So we don't know exactly how it will unfold specifically, but of course, I'll bring you all the details that you need to know. So make sure to hit that subscribe button or hit that like button, because that will make it more likely that I will show up in your recommended feed. So you got to do that, all right? U.S. wealth gap rises with Jackson Hole coming at the top. Jackson Hole is in, just a few days actually, end of the month, and this is an important time. The most important meeting for the Federal Reserve comes at this time, and we might get some details right around then, or perhaps at the September FOMC meeting, and that's going to directly impact you, because as you have seen, the market reacts negatively to the risk off. If the markets go risk off, then that's not too good for people's portfolios when they're in higher risk assets like equities, especially growth stocks, but we'll talk more about that in just a second in the Money GPS Insights. Hang in there. Gap in asset income per capita rose sixfold from 1990 to 2019. Country level analysis shows the dearth of assets income across the US, essentially just showing you, look, let's be honest, in any case, you look at this throughout history, even as they show here, widening gap between the richest and the rest of the country. You've seen it so many times before. Let's get into the Money GPS Insights. Number one, the Federal Reserve is talking taper in 2021, making it very clear, very specific what their intentions are. Number two, we know that the market reacts negatively to this type of information. And of course, if they go through with it, it's not as if the market is going to crash that day, but it means that it's time to go risk off. Number three, riskier assets could see a sell-off and value can make a comeback. And of course, this could be a reshuffling of the portfolio even starting now if the belief is that the taper is coming. I found this to be very interesting. Wanted to show you. Palantir buys gold bars as hedge against a black swan event. So we're seeing some unusual things, right? You got the companies buying Bitcoin for certain reasons, and you've got now this case here buying gold bars. You don't hear about that too often. Companies spent $50 million on 100-ounce gold bars in August. Consumers can now pay for software in Bitcoin, though none has, okay? So I just found it interesting, wanted to show you that. Look at what's going on with housing. We're talking about real estate, we're talking about housing here. And you could see the housing starts had declined somewhat. If I pull this back 5 years, you would see there are fluctuations. We are still, though, much higher than we were, let's say 2017, 2018 into 2019 timeframe. Okay, so I just wanted to give you the context, because whenever you see a chart, it's always good to see that context. Let me know what does the number mean, right? I want to see it historically. Canadian inflation jumps to 3.7%. And of course, you're seeing this being the highest since 2011, mirroring generally what we're seeing in most other countries. And what is it that they're going to do? Well, in Canada, they've already reduced the amount of money that they're printing every month. They are not going to give up on the amount of money that they are sending out to people. That is serious, desperate times right now. And so we'll see how they react to inflation being persistently higher. Buying frenzy proportion of, this is the stock market talk, by the way. Buying frenzy proportion of buy recommendations in US and Europe is at the highest in years. So essentially what we have is extreme bullishness that's going on right now from the hedge funds, from the institutional money, from the retail side. Everybody is saying buy, buy, buy. But at the same time, you have this from Goldman Sachs. After GDP growth peaks in mid-2021, we expect a sharper deceleration than consensus to a trend like 1.5% to 2% in the second half of next year. So, okay, everything's great. We have growth peaking out, as I showed you in the previous video, actually, where growth had come down significantly from its peak. Doesn't mean that it's not growing. We're talking about, year over year changes. We're talking about how accelerating that growth is. And you could see that the belief that they have is that this is going to slow down. Of course, they say 1.5 to 2% because they always say that. But it just shows you that there's definitely going to be a slowdown, and they're not saying it's going to be a deflation. They're just saying there's going to be less growth. And their hope here is that the economy doesn't have to run on stimulus anymore. But we know that. We have cut our Q3 GDP growth forecast, but raise our forecast for later quarters. So saying that it's more sustainable and so on, who knows? All right, that's Goldman Sachs. Soaring cost. This is a heartbreaker. Soaring cost of food is forcing families to scrimp at the dinner table. Inflation is slamming the freezer shut and leading households around the world to make sacrifices. Never a good thing. People always say, well, that store is greedy. That business owner is greedy. But people don't realize why are prices higher. And then you'll say, oh, well, it's the supply chain. It's the bottlenecks. That's why it's higher. It's got nothing to do with money printing. But if they would have realized, open up the history books, please open up the history books. When you hear this kind of talk from people, ask them to learn about 1971. What happened that year? And this will help to understand why the inflation never stopped. As soon as 1971 occurred, as soon as that time frame of the 1970s happened, the prices never stopped going up. That's what we need to understand. 1/3 of American families couldn't cover a $2,000 emergency. This is the stats, January 2020. So what's going on now, today? The numbers must be much, much worse, and I am interested to see when I get those for you. But I've seen other stats of 400, 600, and so on. It just depends on who they're surveying. But it's not good. 61% of Americans paid no federal income taxes in 2020. More than 100 million US households paid no federal income tax. Okay, the federal stimulus led to a huge spike in the number of Americans who either owed no federal income tax or received tax credits from the government. So a lot has generally been different from what we had seen before. And so, I think that the governments right now are running debt and deficits that will be impossible to pay back. How can they do it? Central bank could print up the money, buy it all, and who knows? We'll see. I'm going to end it there. But what you need to know is in the insiders. The insiders is my way to get to you directly. If you want to get that, very simple, hit this card up here or go to themoneygps.com. But hold on. Don't click off. Did you click off? That's right. Listen, all of my favorite Janet Yellen fans give a thumbs up before they leave the video. And if you are a Janet Yellen fan, as I am, then you want to do that to support this channel. And of course, Janet Yellen as well. Hit the thumbs up. Much appreciated. And if you haven't seen this video yet, you want to click on it, definitely click it, and I'll see you there.